Hi, in today's masterclass we are going to take a look at momentum indicators and oscillators. So for today we're going to take a look at what momentum indicators and oscillators actually are. We're going to look at some examples of these, and we're also going to take a look at how they are used. So first of all, what are momentum indicators and oscillators? These are technical indicators with a series of data points calculated from a formula of the price data of any particular market or asset. Price data could be any combination of the open, the high, the low, or the close over a period of time. Some momentum indicators use only the closing prices, whilst others may also include other data, including volume and/or open interest. Price data is inputted into the formula and a data point is then calculated. A time series then of data points is created and a comparison can be made between past and present levels. Momentum indicators are usually shown graphically below a market's price chart. Now we're going to take a look at some examples of momentum indicators. Moving averages are themselves a momentum indicator, and we do cover moving averages in a little more depth in one of our other master classes. So here we have an example of the daily ASX 200 chart and a 50-day simple moving average. This is a momentum indicator. Momentum itself, the word momentum, the momentum indicators come from one of the original momentum indicators derived. And here we have the daily ASX 200 chart again, and here we have the momentum indicator. Momentum itself is an indicator, oscillating up and down, above and below a zero line. We also have the relative strength index, or the RSI. Looks similar in here to the momentum indicator, but this oscillating between 0 and 100%. Between 0 and 100%, the RSI relative strength indicator. And finally, we're going to take a look at the stochastic. The stochastic in here has two lines, again oscillating between 0 and 100%. Again showing it here on the daily ASX 200 chart. And in this case, we have two lines that cross over. So how are they used? Well, here we're going to look at three ways in which they're used. For overbought and oversold indicators. And here we have an indicator here, the RSI, hitting overbought territory. It's going very high in here in the lower part of the chart. And we can see in here, we have the daily ASX 200 chart in here going to an overbought condition. And then the market correcting, retracing after it hits that overbought position. Divergence is the second thing we're going to look at here. What does divergence mean? Divergence here is when the market hits a new high, but the oscillator does not hit a new high. So here we can see the market hitting new highs and the oscillator not hitting new highs. That is called divergence, and sometimes an indication that the market is going to correct. And we did in this case see the market correcting back lower. And the final way we're going to look at using oscillators and momentum indicators is for trading signals. So quite simple here with momentum, we have the zero line that we talked about earlier on with momentum. We may have a very simple trading system whereby the market, we buy or sell the market each time it crosses above this zero line. And there are other various ways we could use different indicators for trading signals. So in this masterclass, we've looked at momentum indicators, we've looked at some example of those, and we've also looked at how they are used. This has been Steve Miley for The Bull, and please do join us again on thebull.com.au and thebull.asia. Stay bullish.